Hey everyone, this is Trading Logics, and today in this video, we're going to talk about, smart money concepts. Specifically, we're going to talk about supply and demand. Now, more often than not, if you are a new trader, beginner, or intermediate, what type of content are you can ask yourself this: what type of contents were you first exposed to? It's probably retail concepts like MACD, RSI, and all that stuff. I'm personally not against indicators, but I'm not a big fan of them because the problem with this is people use indicators, but they don't understand the reason behind indicators. If you're not a coder, you don't really understand why the market is going up with because the MACD is crossing over. What does crossing over mean? It's just two lines crossing over, but why does it tell you to long? You know, and RSI itself. Why does the RSI go up? What does RSI stand for? Why is it a strength index? What is it for? What is the importance of it? How do you know when it's not working? How do you know it's working? So these are the questions that we have to ask ourselves when we want to use indicators. That's the bare minimum. But I really want to talk about premium and discount in this video because I feel like this smart money concept is very underrated among YouTube. You don't really get a lot of people watching these type of contents because people tend to want to get the easy way out. It's just like want to use a special system. Two candles go like this, and I want to take a long, and then I can close my eye. Next day the trade goes and take profit. That's not how it works, is it? If you take your trade before, you know how it works every time. It's so complex. Anything can go wrong. But in this video, we're going to learn about the most basic structure. Not that it's inferior, but it just means it's basic. It's very important. It's the fundamental concept. Okay? And that is premium and discount. So, what is premium and discount? So, I'm going to give you a little metaphor. Let's say that you want to buy a laptop, a PC, and it's worth $1,000. It's the equilibrium price. It's the market price. You go to a store. You go to multiple store, and it is $1,000. Now, if you have the budget, you might buy it, but if you're trying to save money, you probably will not. You're looking to buy it at, let's say, a discount. So let's say it's a special Christmas event and it's selling for $800. So there's a 20% off discount. Do you want to buy it now? Yes. Okay. So this is what buyers are trying to do. Buyers are trying to buy at the lowest point possible. What are sellers trying to do then? In a financial market, in a trading market, we have two parties, buyers and sellers. Okay, so what is buyers are trying to buy at the lowest price possible, and what sellers are trying to do are trying to sell at the highest point possible. Another example of sellers trying to sell at the highest point possible, it's, let's say, you bought a house in 1980. Okay, you bought a house in 1980s and the house was 100,000. In 2023, it's worth $1 million. Let's say it's worth $1 million. Okay, I don't know the exact figure, but let's say it's worth $1 million. What would you do? Let's say you want to sell it. How much profit will you have? 900,000. Now, this is what sellers and buyers are trying to do. So sellers are trying to sell at the highest point possible, and usually these are appreciating assets. They don't want to use like laptops. Sellers are not that compatible with laptop examples because if you buy a laptop, the second you buy it, it's considered secondhand, and the value of it will just keep depreciating. Now, still, the concept applies that sellers are still trying to sell it at the highest price possible because they want to get the most profit out of it. Okay, they want to get the highest profit out of it, but the problem they're going to face is that depreciating assets are not going to work in their favor. Appreciating assets, on the other hand, will work on their favor. For example, a house, gold, certain furnitures and antiques will work in their favor. Okay, so let's get right into the chart and explain how the premium and discount applies to our trading. So let's get to a less crowded screen and let's go to a blank area. We're going to draw a very simple move up, move down, move up. Okay. So if you have never heard of SMC, which is smart money concepts, do you even know what this is? Have you heard of it? Do you know the reason behind it? If you had watched some previous YouTube videos before, you might have heard people say this as the equilibrium, the Fibonacci, the retracement. But these phrases have a problem. All these phrases has a problem. They fail to explain why is it retracing. Why is the price retracing? All them saying that, oh yeah, the price is retracing to a point. Why is it retracing then? You don't say it's retracing because it's retracing. You say it's retracing because of logic, because the buyers are trying to buy at the lowest point possible, and the sellers are trying to sell at the highest point possible. So let's say you were a seller. Where would you sell this thing? Let's use the same PC metaphor again. Let's say it's worth $800 here, it's worth 1,005 here, and it's worth $800 here. If you were a seller, sorry, not 1,000, let's say $1,000. If you were a seller, which price point would you sell it on? You want to sell it on the highest price possible, and that is this. You want to sell it at 1,005, and if you were a buyer, where would you buy it? Now let's say that you didn't enter here. You missed the move up. The price went up. You missed the move. So which area would you want to buy? Here. Okay. You want to buy at the retracement. But more often than not, people make the mistake of FOMO. FOMO is stands for fear of missing out. And what they tend to do is that buyers, they kind of enter at the top, which is where sellers should be selling. They enter where sellers are selling, and what happens is that their position goes in negative and potentially gets triggered stop loss. And that's how it is. That's how brutal it is. If you were a buyer and you bought it at here, where would your stop loss be? Generally, we would put it below this area. In the future, we're going to go in depth on how we put our stop loss and take profits. It's not easy to really include everything in one video because there's a lot to cover, and this is a very interesting topic to talk about. So if you were a buyer, we want to buy it at $1,000. Now, where your stop loss would be below the swing low, and your target would probably be higher around fair value gaps, order blocks. What is that? Something that we will learn in the future. Okay, it's a very simple yet powerful concept. Okay, so why does the market go down then? This move down. Why did it go down? What is the reason behind it? Can you guess? Can you guess why did it go down? Can you at least guess what it means? So let's draw an economic chart. Now, if you have learned economic before, you are familiar with this simple chart. Let's say that you have a supply, you have a demand, you have a price, you have a quantity. And the very basic of this is supply and demand. You have the equilibrium here, and this is equilibrium one. The equilibrium one is basically this. This is the equilibrium. So I want you to grab a tool from your trading view on your left hand side, go to the third box, call it gun box, and I want you to draw out your gun box from swing high to swing low. If you do not know what swing high and swing low is, a quick summary of it is that swing highs are like this. This is swing high, this is swing low, swing high, swing low. Simple. Okay, so let's do the same thing on downtrends. Lower high, lower low, lower high, lower low. That's how it is. Simple as that. So your gun box is meant to draw at the higher high and the higher low. Okay? So now that you have the swing high and swing low, where is your entry point? Earlier I said that buyers are trying to buy at the lowest point possible. Buyers include people who trade derivative futures market. If you are a person that wants to long, where would you want to long it? Ask yourself, where would you want to long it? Would you want to long it at the top? If you want to long it at the top, that means you're being influenced by FOMO, and that's how it is. Okay, and I want you to enter at here, equilibrium. Now, if you are a beginner trader or you're just starting out, to play it safe, you want to enter directly at the zero point 0.5 equilibrium line. If you are a bit more advanced, you can lower your entry, but it requires some intuition. So if you don't have the experience, it's best to just stick to zero point 0.5. It works really well, in my opinion. And you're probably, let's say you are a beginner and you entered here and you put a stop loss, let's say here, and you target, let's say, a fair value gap. This is a 1 to 2.6 trade. Now, I don't know if some of you will think 1.26, that is so little. I want 1 to 20. The truth about high risk reward ratios are really something that people have to understand. Some people, they want 120, 130. But do you know what that means? Do you know what 1 to 20 and 1 to 30 even means? Let me just show you what it means. Let's get right into the charts. Okay? 1 to 20 means this. You're taking a short, you're putting, sorry, what is this? If you're taking a short and you're putting a stop loss very tight, you have a very small stop loss and you have a very big target. Okay, you have a very tight stop loss. This is what it means to have 1 to 27 risk reward ratio. And in the crypto market, especially crypto, do you know how volatile the market is? Do you know how easy it is for you to get stopped out? Within seconds, you would get stopped out. If you were lucky, you might have to try it multiple times. For example, you might need to take multiple trades. You're going to get stopped out at least, I can't give you a figure, but let's just say on average, you get stopped out 10 times. That means you open 10 trades, 10 commission, 10 trade fees. You're going to pay for that. That's just how it is. And not only do you have to pay for the commission, you have to pay for the leverage, you have to pay for the position size, and you have to pay for the stop loss. Okay, taking a trade is not about stop loss. It's about, well, fees. You have to pay for fees. Let's not forget that. So you are going to get stopped out 5, 10, 20 times for you to even get one good trade. So you have to ask yourself, if you get stopped out 20 times, how would you feel? Would you be able to be confident and you're sure that your market is going to go in your favor in the end? But are you going to be strong enough to handle the drawdowns? So if you're not that type of trader that is very advanced and very experienced, I suggest you just stick to 1 to 1.5, which is my minimum grade. Is 1 to 1.5. That is the minimum I expect. Anything lower than that is not ideal. 1 to 3, 1 to 4 are really great type of risk reward ratio. Okay, so let's get right into the charts and explain to you what it is. Okay, so a quick concept I want to introduce you is called fractals. The market is fractals, and we're going to talk about it in the future because there's a lot to cover. But a very quick explanation of it is that you're going to see this move, a swing high, a swing low. But here's the thing: inside this market, you're going to see a lot of swing high and swing lows as well. So that is what we call fractal, okay? A fragment of the market. So let's look at here. How do you draw your gun box? I'll draw it for you. It's like this. This is how you draw it. And now you see the same metaphor being applied. $800, $1,000, and 1,005. If you were a buyer and you did not enter here, where would you want to enter? You want to enter at the $1,000 mark. If you were a seller and you want to sell at the highest point possible, where would you want to sell it? Here. Do you want to sell your position here? No, because that's a $200 profit. If you sell it at the top, it's a $700 profit. This is a 1,005. So if you sell it here, it's a $700 profit. If you sell it here, it's 200. So you think about it. Where would you want to sell it? As a seller, where would you want to sell it? That's the question you have to ask yourself. Same thing. Another equilibrium trade. We go up. Where do we stop at? Equilibrium. You enter here. You put a stop loss. Let's say you enter here. You have a stop loss here. 1 to 2. Is that not great enough for you? So the green box is where you want to enter. That's a very ideal zone to enter. The red box is where you want to sell it. You want to visualize it by putting colors. You can use it by using the settings. So let me just show you the settings. This is the setting. Okay. If you use the default gun box, they're going to have a lot of boxes and all that stuff. Just remove it. You don't need them. Okay. Now, alternatively, you can use an Fibonacci if you're a bit more advanced, but then it doesn't really make a big difference because it's really much the same thing. So you're seeing basically the move up and the move down to the equilibrium, which is here. Can you see the 0.5 here? You pull it here. That is the equilibrium right here. That is the equilibrium. Okay. So essentially, you're trying to enter at the equilibrium or the discount area if you're buying. If you're selling, which is I'm going to show you here, let's say you want to use a gun box and you want to sell this market, where would you want to sell? Tell me where you want to sell it. Okay, I want you to point out exactly where you want to sell it. Look at the price point. Here's a little test I give you. Okay, where would you want to sell it if you were a seller? Let's say this is the swing high and this is the swing low. Where would you want to sell it? The highest point possible. Okay. So let's say you sold it here. Let's say you're not God. You didn't get a good entry. You entered here, and your stop loss is here. Let's say I'm going to draw it out and visualize it for you. Let's say you have a stop loss below above the swing high, and the market goes down, and you take profit here. That's a 1 to 4.6 risk reward trade. Okay, it's a very beautiful trade. Okay, so you see, earlier I talked about equilibrium, right? But the market is not efficient, especially crypto markets. Crypto markets are not efficient. We don't have this type of stuff. We expect it to do this equilibrium and then go down, right? But that's not how market works. Markets are manipulated all the time. What we're going to see more often than not is a manipulation, making the people trying to FOMO and all that stuff, and then only they come down. So probably a lot of people bought at the top. They're buying at the premium. They're buying it very expensive, but then they get stopped out. That's just how it is. That's how brutal the market is. Now, for some of you that have heard of patterns, you might see this as a witch. You might see this as a bear flag. Whatever you call it, there is a reason behind these type of patterns. I don't want you to just oh yeah, that there's a pattern there, there's a reason there. That's not really a good explanation. A witch, what are you trying to say? A witch? Are you eating a wedges? Are you seeing a bull flag? Is there a flag in the candlestick? Not really. We're just giving them names, but we have to understand the underlying cause of these type of patterns. Why do they form? You know, and just one final example. Let's say that you were. Let's remove everything. Let's say we're gonna let's say we're gonna zoom in a little bit. Okay, if you were a buyer, and let's say this is the swing low and this is swing high, and this is why it's very important to stick to your own principles. If you entered here, $800, let's say the computer metaphor, you bought it at $800 and it's worth 1,005 now. Okay? If you are a buyer, tell me, will you panic when the market does this? When the market goes up here, will you panic and enter along because you say, oh, look at the price, it's going up, I want to enter now. But then you put a stop loss here and you get ripped away. This is why it's important to stick to your principles. Zero point 0.5 is where the minimum point for you to enter. You can enter here, you can enter here, you can enter at the zero point 0.5. If you're going to enter lower, you might not get filled, so that's one thing you have to keep in mind. If you entered here, you might have a chance for the price to go lower than that for it to go back up. So there are its pros and cons, and you have to make your own decision of where you want to enter ideally. Okay? But just because the market went up here and went up, this move up does not mean it will go up from here. This is a misconception people have. People see a little move up and they think it's going to pump. But has it even reached equilibrium yet? No. But let's say the market did go up. So what? There are going to be many opportunities in the market. You don't want to rush in anything. You're going to hurt yourself in the long term. Trust me on this one. And zero point 0.5, if you stick to your principles, you took along here. You place a stop loss here. And I'm going to talk about exactly how you put your stop loss in the future videos because there's too much to cover. But for now, where would you generally take profit? Somewhere here, 1 to 2.7. If you want to play it safe, 1 to 2, 1 to 1.5 is going to do it as well. Simple as that, you took a profit on this trade. It's just as simple as that. It's not that complicated. It's not. Don't make it complicated. Don't crowd your screen with 20 indicators. I know some of you all, which is including me before, I have the misconception of having 20 indicators on my screen. I want 5 DMAs. I want a MACD. I want an RSI. I want a Bollinger Band. I want a candlestick finder. And the problem at the end of the day is the chart is so crowded with all these doodles that I don't even know what I'm looking at anymore. The price is basically crowded. Let me just imagine how it looks like. There's like 20 EMAs. You have 20 EMAs going on here. You have 20 EMAs, and you have this candlestick finder. All these boxes drawn, and you have the MACD at the top of the screen, crowding everything. You can't even see the screen anymore. So really, don't use indicators if it's really not necessary. Okay, stick to basic logics. Okay, premium discount. Okay, so a quick recap on what we learned is sellers are trying to sell at the highest point possible, and buyers are trying to buy at the lowest point possible. When this concept is applied, when buyers buy the position, buyers think, okay, this asset has value, so I'm going to buy it. When it is bought, the market price goes up. When seller sells their position, the market goes down in price. Simple as that. Do not overcomplicate the situation. Do not try to make it very complicated with all these random theories. Stick to the basic one. Basic does not mean inferior. It means it's simple and powerful. Okay? So, this is it for this video. I hope you learned something in this video. And since I'm a really new creator, I really hope that everyone in the comments will at least participate a bit in giving me an opinion. What do you think about my video? Do you think it's helpful? Do you think I'm speaking too fast? Do you think that I'm not explaining things clearly? Do you have a question about my video? Do you think my, well, anything, the mic quality, the video quality, what do you think that needs improvement on? Your opinion really matters and I really want to hear it. And if you found this video really useful to you, then you can consider taking a subscribe button or liking it. And I will hope to see you in the next video, which I would be uploading within the next week. And I hope you would stick around and potentially be my long term subscriber. And I really hope your journey in trading really succeeds here. So thank you for watching.